I'm Ella Wilkinson, Studio Director at BizClick, and your guest host for today's episode. Today, we have the privilege of being joined by a visionary financial leader, an international multi-award winning finance executive with over 2 decades of robust experience, spanning business and financial leadership. I am delighted to be joined by Amit Agrawal, the Group Chief Financial Officer at Faris Group. So, hello, Amit.
Hi, thanks for the wonderful introductions. I have never thought of myself in this way, the way you have described. It's just wonderful to hear sometimes your praises like this.
Sometimes you need a bit of a boost from someone else.
Absolutely.
So, obviously, I've talked about you being a multi-award winning, 2 decade long hero of business. So, tell me about you. Tell me how you got into finance.
Yeah, interesting. So I wanted to actually become something else. Back when I started my career, I just wanted to achieve something. I wanted to establish something of my own. I wanted to establish an identity for myself. I come from a very business background family. None of my relatives or ancestors or even my contemporaries were ever in job. They were all business people, right? And I never wanted to get into the family business. I never liked it. I wanted to go into corporates. I want to establish something big. I wanted to do something big in life. And that's when I thought, and again, I have a very humble background, right? So I thought that the only way to get through it is educations. And when I came to know of a course in India, which is called Chartered Accountancy, which is similar in the UK and other parts of the world, I realized that's a thing that I can do quite easily because I was a bright student. And
Mm,
the only reason I didn't go for an MBA and didn't go for an engineering because they were competitive exams. So that means that somebody does better than you, you don't pass. But
right.
chartered accountancy is an exam where if you get 50% in aggregate and pass in all the subjects, you become a chartered accountant. And I didn't wanted to go into a competitive exams. So I went into exams like chartered accountancy. And when I started studying commerce, I just fell in love with it. Again, I come from a background where, since my family is entirely into business, I've been hearing all these terms in finance, interest, capital, principal. Uh, you'll be surprised that when I was 4, 5, 6 years old, and my father used to talk about business with my elder brother, and they used to talk about how much is the profit. And my brother would tell me, okay, we have profit of X amount. I said, no, 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 that's not the profit. Reduce the notional interest of the equity and then tell me what is the profit. So that point in time, he was talking about economic value added, right? Which is after deducting the cost of equity, which much later on, when I started my career with Tata Steel, a company called Stern Stewart, they came and sold that concept of economic profit to Tata Steel, earning thousands of dollars for that consulting. And when I saw that concept, I said, "Hey, what is this economic profit? This is the same thing which my dad used to tell my brother years back." So again, the point I was trying to make is I come from a business family, so finance came naturally to me, right?
Mm.
And when I studied finance, I realized that I'm good at it.
It's always the way when you find a subject that you're good at, it's smart to follow that path.
Right, absolutely.
So how did you find yourself in, the heavy industries? Obviously, you started at Tata Steel.
Yeah, I started Tata Steel, so I started with heavy industries, right? And I started even in Tata Steel, I started with coal mines. So 2 years for my first 2 years with in a colliery, where I was responsible for management accounting group, which today is called financial analysis and reporting. And and there is where I realized that the core of the finance, the key to the finance is value creations and value added services, which is basically analyze, do the analysis, look at the numbers, analysis, and help in decision making. And honestly, I fell in love with this job in the first 2 years that I spent in that coal mine. I had a excellent boss, both in terms of my functional boss and my administrative boss, who was the general manager of the colliery. Uh, and under their guidance, the 2 years that I spent there, that has built up my entire foundations. Because And you'll be very surprised because when I was transferred to the colliery, I was supposed to be joining purchase accounting, which means that I would be, just signing off the invoices or doing invoice verification and making the payments.
Mm.
But when I landed up there, and I got my boss took me to introduce to the general manager. He told him, "Okay, I want to see a clone of you in him, and I want him to be handling management accounting group." And that's how I landed up in the management accounting group. And I'm so thankful for that decision that that has made me what I'm today. I know what value creation is, and I'm not taking away anything from the purchase accounting. I'm not taking away from the usual accounting, which is still important: the taxations, the payroll processing, the payment AR, the APs, reconciliations, the asset management, and all those things are still important. But the kind of kick that you get when you do when you're part of P&A and you're help in making a decision where you tell the management how the business should be run rather than reporting what was earlier told or what has been earlier achieved earlier. So that is really a kick. It gives you quite a lot of uh, a kick and satisfaction end of the day that you are contributing significantly to the organizations.
This podcast is in partnership with Amazon Business. Amazon Business is your one-stop destination for everything your organization needs. Think of it as the Amazon you already know and love, but specifically re-engineered for the way you work. Amazon Business gives you access to business-only pricing on millions of items and quantity discounts that scale with your growth. It's about spending less time bogged down in those manual tasks and more time on what really matters. So head over to Amazon Business and make the power of Amazon work for you. And that's really interesting because I think management is so important. It's so important to have a manager who's behind you. So now you're in a position of like significant leadership. How do you pay that back to your staff?
The way I'm looking at all my team and most of my team is by empowering them, by not giving them a fish rather than teaching them how to fish themselves,
Mm.
right? And I mean, incidentally, today I was having a discussion with my procurement manager. So we have a store manager, assistant manager, a store who has joined as newly, and I had requested him that after 30 days, I expect you to make a presentation to me of what are your findings, what are your challenges, and how what are the action points that you see, we need to do improve, how do we improve ourselves and all. And the assistant manager, warehouse manager reports to the SCM head, supply chain manager, right? And I was having this discussion with the supply chain manager. And the supply chain manager says, yeah, but I have given him the list of these things that I expect him to do. I said, no, you should not have given them his list. I wanted him to think, look at our organization and come up with the points that what he thinks that he needs to do. And then we
Mm.
could have filled up the gap. Now you have restricted him in a boundary of certain areas. He will not look beyond that, right?
Yeah, and
So
teaching him that, he doesn't necessarily need to use his brain. He can just ask.
exactly. Now, what he will do is fall back on those 10 points only and work only around those 10 points. And you will never know that there are four more improvement areas or four more things that we need to do. So, first, you allow him to do his work, let him think, come and make him, let him do the presentation on his own. And then we tell him that, okay, no, you should look at this also, this also. And then maybe in the process, we also learn two, three more things.
Mm.
Right. So that is how I do with all my team members. I always tell them, no, and finance is in a very unique positions. I always say to in my entire team member, because we are the ones who have visibility of the entire company's numbers, right? No,
That's
nobody in
true.
the company, any bit of operations do not have visibility of the entire numbers. So we are the one who are in this exclusive positions where then we can look at a complete holistic picture of the company and especially the FP&A people, because you are the one who prepared the reports. You can analyze and you know the history, you know the trend. And if you have a little bit of sense of business, you also know which direction the business is going. And therefore, you are in the best position to advise to the management, to the top management, right?
Absolutely. You have the only bird's eye view apart from the CEO.
No, CEO also depends on you to give him a bird eye view, right?
Yeah. So obviously across your career, you've spanned from heavy industry back to heavy industry now, but you spanned from healthcare and logistics and then full circle back to heavy industry and private equity. How have the challenges varied in the different areas you've worked?
And what you missed in between was I went to the private equity, right? So I started with the heavy industries, and it's been good 7 years in Tata Steel under in different roles. And in all of those roles, I was handling most of, and luckily I was handling the strategic part of the, because a company like Tata Steel is a huge organization. So there are people who are involved in transactional part of it and the people who are involved in the strategic finance side of it. So luckily I was always involved in the strategic finance side of it.
Mm.
And plus I also learned to do few things because I was responsible for spinning off a company under Tata Steel, which has never happened in the history of Tata Steel. So we decided to spin off nine of the business to a separate entity altogether, because these are the nine businesses were non-core activities of Tata Steel. And we thought that by now spinning off it as a separate company, those businesses will become the core for that company, and it can provide services to the Tata Steel, and it can start providing services to the other company. I wrote the first concept note of this company, and it got approved. I wrote the article memorandum of this company. I registered this company, and then I was the second employee to get transferred to this company. Yeah. And then we set up the company, what the company should look like, how the contract should be, what should be the organizational structure, which businesses we need to grow, which business we need to consolidate, which business we need to take to the national level, which to the state level, which to the regional level. So all these was decided. I was even part of the implementation of the SAP there. So that was my first implementation experience of an ERP. So all those things I did at Tata Steel, and then I realized no, I need some international experience, and that's how I moved to Kuwait and Al Ghanim Industries. But I got so quickly bored there because I had done so much strategic finance, and when I joined Al Ghanim, it was like for 2 years I was like looking for a lot of work. Even as a finance manager, and the pay was good, but then it was not satisfying to me. I realized that the job profile was pretty much same what I was doing in my first job, right?
Mm.
And after 6 7 years 7 years of experience, I didn't want to do the same thing, and I realized if I continue here I would get rusted. And that's when I went and told my CFO, no, I give me some more. And he gave me a couple of projects, but that's finished. And I was not satisfied. I asked for more, didn't had much because it was a trading organizations. And then I got an opportunity with private equity. And I mean, as a finance guy, we always used to look up to private equity. It was glamorous, right? You buy, you sell company, you sit on the boards, you hire CEOs, CFOs, and all. And I joined this private equity called Global Capital Management, which was a private equity arm of Global Investment House. At that point in time, it was the second largest private equity in Middle East. We had an AUM of $3 billion, and I joined their transformation team. We had about 40 people, team members in that organizations. When I joined, I was a little, oh, I'm joining the second largest private equity in Middle East with $3 billion AUM, so it must be something. And you won't believe it, in 6 months' time, I realized that out of all those 40 people, no one knows how to run a company. They were all investment banking background. They were all research analyst background, credit agencies background. So they knew how to buy and sell company. They knew
Mm.
how to do evaluation, but they have absolutely no idea of corporate governance, of delegation of authority, what a balanced scorecard was. So they have absolutely nothing. And that was the year when we had launched our buyout fund, which means that all the investments that we were doing earlier were minority or significant minority, but we didn't had a buyout where we are holding majority. This was the first one. And then in the next 2 years, I had the experience of my life. I was managing three of the largest buyout transactions, sitting on the board of all those three companies. I was, talking to the CEOs, CFOs, giving them the balance scorecard target, helping them transform the company from, you know what private equity does, right? So private is equity. I generally compare it with the manufacturing industry. In manufacturing industry, what happens is you get different kind of raw material, you process it, and you make a finished product, and then you sell it outside. That is exactly private equity does with the company, right? You get a company, you improve the company, you improve the bottom line, you institutionalize the processes, you increase the product, you increase the footprints in terms of geography, in terms of product lines, you increase the valuation of the companies, and then you exit. So what the people do in the manufacturing on the raw material, the private equity guys do on the company. And that experience was again the best learning experience. And that's when I also realized that most of the CFOs and that you find in the region are not private equity focused, which means that they're not very strategic. They are more of reporting CFOs who focus on risk compliance and control, but not so much on the strategic part, in which direction should company move in.
So
And yeah.
sorry, you go.
Yeah, and that's when I decided to move out of it, I was offered the group CFO role for one of the portfolio companies, and then I picked up as a CFO of Jasim Transport, and that's where my CFO journey started.
So do you believe then that your private equity background has given you a very unique overview that most CFOs don't have? You have the strategic and you have the day-to-day running of a business. You understand both sides.
100%. I think both on my experience with Tata Steel and my experience with private equity together combined has given me that perspective. When I was working with Tata Steel, it is this great company to work with. The kind of processes, the kind of principles they follow, the kind of value system they have. I mean, the kind of things that they have learned. I have learned 25 years back. I'm still currently also I'm applying in my current company. It's so valuable. And the private equity perspective gave me not only how the business should be run, but also what is expected by the shareholders, what is expected by the other stakeholders, what is expected by the management, what is expected for the employees. So it has given me a complete 360 view of how a company should be.
Absolutely. So obviously you're now back in heavy assets business. So let's talk about how you can keep those finances lean while working in a heavy asset business. So obviously in heavy assets, there is a constant tug of war between maintaining a disciplined hurdle rate and making long-term strategic bets. So how do you decide when to stick to the internal rate of return and when to lean into that generational asset play that actually doesn't look perfect on the spreadsheet today?
Very pertinent question when it comes to the asset-backed organizations. See, it's not a decision of either or, right? I mean, you have to go by the spreadsheets. You need to get driven by the usual matrices, which is NPV, IRRs, and all on the feasibility studies of any investments and all. You have to do that. I mean, because without that, you can't be just strategic and taking the decision from the gut. So you need to take decisions based on the spreadsheet, but at the same time, that spread should not be the one which should be driving your decision making. It is a tool for decision making, but it is not that it doesn't give you the decisions. So
Mm.
you still need to go back and look at a lot of other matrices and other questions that you need to ask and look at the strategic intent of it and then decide whether you need to make that investment or not, or whether you need to allocate that capital or not. Because capital end of the day is scarce, right? And there have been a lot of real life examples that we have faced through where we have incidents where Excel sheet numbers were not great, but we still decided to go with business for that investments, right? I mean, a classical example would be, I would say, if you compare Chinese equipment versus European equipments, right? Now, Chinese equipments are cheaper, one third of the European equipments, but their life is also shorter. The quality is not that great, right? So if you work it on Excel sheets in terms of NPV and RR, in 5 years, 10 years, then after 10 years, I mean, the challenge with the spreadsheet is once you do the discounting factor, after 10 years, the numbers becomes negligible, whatever good the number looks like, right? So the Chinese equipments, most of the time it comes out as a better decision to make. But most of the time we also decide to do the German because German equipment doesn't age, right?
Mm.
I mean, you will be surprised when I tell you that, I mean, we have equipments which still runs after 20, 25, 30 years that's still as good as new. And if I sell them today, it will give me more value than what price I bought them 20 years back or 25 years back because the
So
price increase has happened.
it's a no-brainer.
Yeah, it's a no-brainer. But if you work on an Excel sheet, your Chinese equipment will come out faster and quicker because when you do a discounting factor, anything which is more than 10, 15, 20 years, it doesn't give you much value out of it.
Mm.
So
So is that something that came with experience? do you think, or is it something that comes from your gut?
A combination of both, right? Gut usually comes gut comes usually from the CEO, the experience and the Excel sheets and the knowledge then learn with the business. Also, you have to be deeply as a CFO, you have to be deeply involved in the business, not only on the Excel sheets and not only with your accounting team. So in terms of time spent, I would say I spend like 75% of the time with the business and 25% time with my team, right? So when I'm involved with business, I look at business perspective and then make financial decisions on that based on that.
So a lot of companies fall into the trap of chasing EBITDA, but that doesn't pay down debt or fund new projects. Cash flow does, and return on capital does. So, what is your framework for identifying lazy or underutilized assets that look fine on an income statement, but they're actually dragging down your actual returns?
Yeah. So you see, EBITDA is a good concept. I mean, as a concept, it is extremely good. And for simple people who don't understand finance too much, they consider EBITDA same as cash, right? A lot of people, non-finance people consider EBITDA as the cash flow, which is not truly the cash. EBITDA still gives you some kind of projections when you look at the P&L, what kind of cash you should be generating, but it tells you what kind of cash you should be generating, but not what actual cash you have generated. For that, you still need to look at the cash flows, right? So you need to give that explanations to the team, to the especially the BU heads, the business unit heads, and the head of the departments, and explain them that EBITDA is good to look at, but you also need to look at other matrices, which are basically cash conversion cycle. How long is your outstanding? How long is your receivables? How long is the inventory holding time? Because those are the things that EBITDA does not reflect. So end of the day, EBITDA is good to look at from the business side of it, how much business we have generated, how much cash it's supposed to generate, but then you have to always compare and see with the cash flow, actually you have generated that much cash or not, right? And that's where what comes from the cash flow. So you have to educate the your teammates to look at the cash flow as well. So EBITDA is important, but cash conversion cycle is definitely more important.
Yeah. So another core pillar of lean finance then is actually eliminating waste. In an asset heavy environment such as yours, how do you distinguish between the necessary scale and operational bloat?
Good question. So uh, I usually what we do is for any of the investment decisions, we look at few matrices, right? And and the key thing that I look at is basically whether the investment is a revenue generating assets or investment in a revenue generating initiative, or it's a non-revenue generating initiatives, right? So if it is the revenue generating initiative, then your standard tools and matrices, which is basically NPV, IRR, feasibilities, utilizations of the asset, past utilizations, future probability of utilizations, clients, contracts, or order booking, and ideal time, maintenance history. Those things are pretty much there. So you can make that analysis there. So we use those matrices to make a decision on the value generating assets. It's very difficult for the non-value added investments. Like if you have to invest in an ERP, or you have to invest in support systems, or you have to invest in people in the support departments, or a technology for anything, right? So there is that you need to have a little bit of more microscopic view. You people have to understand, and it's to become a culture in the organization that anything which is not revenue generating needs to be evaluated very carefully in terms of I'm happy to invest in that, but that whether it's giving me the right value or not. So once you have that kind of a framework on both revenue generating assets investments and non-revenue generating investments, then you can evaluate. Also, if you are making it a matrix for a performance evaluations of the people, so, for example, for performance appraisals of our head of the departments and BU heads, if you use the matrices like return on investments, return on equity, or return on capital employed, those things forces them to look at these things, and then the entire organization is moving in one direction. and everybody is looking at the best utilization of the asset. And anything which is not there, identified as a lazy capital or investments, or a lazy asset which is not giving you enough utilization or enough a bottom line impact, or if it's having a high maintenance but high utilizations, then still it's not worthwhile to keep. So when the entire organization and everybody is looking at it, it's relatively easy to do.
And it's, I guess, about staying curious about ongoing outgoings. Ongoing outgoings, I guess that's the term I'm looking for. But once the contract is signed, in lots of cases, people just forget about it. So what is your advice to your team, to yourself, to keep on top of all of those finances that are a monthly outgoing?
You're asking about the outgoing finances from the finance, or you're talking about the client's contract or the finance banks?
From the finance. So obviously you spoke about, changing ERP systems and changing those internal strategies. That's generally a monthly add-on,
Yeah.
software add-on.
Yeah.
But usually when that contract is changed, you do it with your phone. It goes up every month, but you don't think about it.
So the way we have again structured these kind of things is all the contracts in the companies are managed by the respective department heads or the function heads, right? And they keep a track of all the contracts which are coming up for renewals, or which are getting over. So we do a value analysis of all those contracts. We look at what we invested for these in contract, or what we expected to get out of this contract. Have we got out or not? Whether the value has been given by that contract or not, right? And that's when we decide whether we need to renew it, or whether we don't need to renew it, or do we need to look at alternatives and so forth.
Mhm. So my final question in this section is, how do you communicate the concept of lean finance across a workforce that has been traditionally incentivized by just upping the output?
So, see, lean finance is a slightly misunderstood term, I would say, because a lot of time people, when you say lean finance, people think that you're talking about cost reductions and just reduce the cost. It is not about that. Lean finance, in my opinion, it is about not restricting how much you want to invest, but investing in something which gives you the right value. So I'm happy to invest more, but whether that investment is giving me the right expected value or not. So that is what we call the lean finance. It's not about achieving more with less. It's about achieving the right value with the right amount of investments. Right? And
Yeah.
again,
For example, your
traditionally,
German building supplies.
yes, and traditionally people are driven by revenue, and they're driven by absolute profit, and that's when the concepts like return on investments, return on capital employed, and these things come into play. You start educating the business with that. You start measuring their performance with that. You start incentivizing them with those matrices and all, and then the things change.
So my final question to you then, as we are running out of time, you have been crowned revolutionary CFO of the year. I'm going to embarrass you now.
Yeah.
How have you moved from a reporting CFO to a value creating CFO?
See, I mean, that is what I live for. And I mean, that is what I aspire to do every day, right? Reporting CFOs are good. You still need reporting. You need compliances. You need taxations. You need your statutory, reportings. You need to look at the controls. Those things are extremely important. But those are again a reporting of what has happened in the past.
Hmm.
How do you help the organization to move towards the future? Is by looking at what should be done, what needs to be done for the organizations to take it from X to 2X, 3X, 4X, 5X over the next 5 to 10 years. And that's when you need to look at you need to become a strategic CFO. If you are helping the organization in making decisions which improves and which creates value for all the stakeholders, not only for the shareholders, but for everyone, for the suppliers, for the clients, for the employees, all every stakeholder needs to be taken care. So you need to work on how you can give a perspective, how you can take the company from X to 5X or 10X to whatever. So you need to work as again, I always say, CFOs should not be named CFOs. They work most of the time as deputy CEOs, right? Just that from a different perspective. You give a financial angle to the decision making of the CEO. And that's how it should be done. The strategic intent with finance, both combined together as a killer.
Sounds like the perfect blend. So if you were going to give your younger self one piece of advice on how to become that value creating CFO, what that you wished you'd heard earlier, what would that one piece of advice be?
Guys, don't just get guided by the finance numbers. Look at the business perspective, because business perspective is very different from the finance number. Finance just tells you the historic perspective. You need to understand that and then use the application of it for the future. So now think about the business, not just the numbers.
Amazing. Thank you so much, Amit. That does unfortunately bring us to the end of our podcast. You have been listening to the Finance Chief podcast brought to you by BizClick and our partners at Amazon Business. Thank you, Amit, for pulling back the curtain and sharing not just the strategy, but the story behind your role. It's a reminder that in an era of AI factories and global scale, it's still the people that truly make the difference. If you enjoyed this deep dive into the lives of finance professionals from around the world, make sure to subscribe so you never miss an episode. Thanks for welcoming me as your guest host, and I look forward to the next episode.